Hi, I'm Greg Hunter. Welcome to USAWatchdog.com. A guest we haven't had on for almost a year. I'm sorry we've had an embarrassment of bookings, but she is a fabulous guest. She is a two-time best-selling author. This is one of her books, All the President's Bankers. This is her latest book that's not coming out until May 1st. And stay tuned. There's going to be a special deal for the people watching this. But this is the upcoming book. Of course, I'm giving it away with Nomi Prins. Collusion, Nomi Prins. But we're talking about central banks. We're talking about how central bankers rigged the world. And let's bring her on, Nomi Prins. Thanks for joining us today on USAWatchdog.com.
Thank you, Greg.
Listen, we'll talk about this link and this discount little deal for people watching this on USA Watchdog. Thank you for putting this up for your book. It's a pretty significant discount. I think it's about 40%. But your book, Collusion, which doesn't come out until the very first day of May. And thank you for coming on and talking about it and talking about what's going on. This book is it says it all right here. How central bankers rigged the world. In your book. You basically go through and before I go on, 80 pages of sourcing for this book. 80 pages. As a reporter, I'm thinking, I wonder how many sources are in here. I'm such a dweeb, such a geek. But anyway, fantastic book. It's the real deal. You talk about how this is the central bankers around the world, not just the Fed, have just rigged the entire system. Where are we with this rigging? I mean, basically, they started rigging. They've been rigging for a long time, but they basically turned it into hyperdrive in the 2008 meltdown. Where are we right now?
Well, right now, if we looked at the major central banks globally, they are holding about $22 trillion worth of assets on their book. If we just look at the top three, the Federal Reserve, the European Central Bank, and the Bank of Japan, we're looking at about 14 trillion of assets. And one of the things that I point out in the book, and those assets are part of the quantitative easing and different permutations of quantitative easing, is that it's not even just the absolute amount of assets these banks are holding, but the fact that they've been these external artificial buyers for bonds, for mortgage bonds, for corporate bonds, in the case of Japan for equities and ETFs, provides an additional leverageable lift to all of these markets and serves to inflate the asset bubbles around all of those markets. So they're holding an epic amount of assets to begin with as part of this 10-year, almost decade production of quantitative easing and other forms of fabricating money, but they're also having an external effect and an artificial effect on all the markets in addition to that absolute amount. And that's important because that's why we're at such massive levels throughout the world. Now, they've done this together. I talk about this in the book, and I've been around the world talking to central bankers as well as people impacted by them, ones that are still within their central banks, one that have left them. And the issue is that this wasn't just the Federal Reserve doing this. It wasn't just quantitative easing from the United States to save our banks that caused the financial crisis. It's about colluding, real colluding, working together, collaborating behind the scenes to ensure that the level of money is cheap throughout the world and that quantitative easing has become the status quo policy throughout the world. So these people talk to each other, not just at Davos, not just at Jackson Hole, not just on the phone, but on a constant basis.
I want to thank you for that because anybody that brought up in the past the central bankers are colluding together, and they would bring out the tinfoil hat comments and stuff like that. But you're saying you've got a nailed, cold, busted that this is not just a Federal Reserve problem. This is a global, a global inflation production of digital currency. Is that right?
Well, it's electronic currency. It's still fiat currency. It's not new. It's dollars, it's yen, it's euros, and so forth. But the idea of this collusion, this collaboration, and yeah, I mean, thank you for mentioning that. It's not tinfoil. It's not weird. It's not like imagined it one night in a dream. It's like there is actual timeline information, some of which is publicly available, and all of those sources are in the book, but that indicate that if one, say, rate goes up a smidge, like the Federal Reserve raises rates a little bit, which they've started to do since the end of 2015, then what happens on the other side of the world? Well, then Mario Draghi at the ECB might increase the amount of quantitative easing the ECB is doing in the corporate market in Europe. So there's always, it's like a seesaw effect of what happens collaboratively, collusively to maintain the status quo of money from the larger countries, the level of cheapness that it has, and also the amount of quantitative easing that they do in the assets that they hold. So when the Fed at the end of this year said they were going to, for example, taper or start to remove assets from their $4.5 trillion book by not reinvesting the interest payments, which are tiny anyway. So we're talking about slivers of very small percentages of their book anyway. The reality is they haven't really done that. They've reduced their book by about $10 billion off of $4.5 trillion since they mentioned they were going to start, quote, tapering. Yet the media discuss this as some major tightening move, as somehow, all of our economies have finally worked because of the central bank activity. Growth is real. It's all positive. The markets are evidence of that, the levels that they are at. And therefore, these central banks, starting with the Fed, are going to taper or going to reverse course of these 10 years. The reality is, if you look at the actual activity of the banks beyond the Fed raising rates by a little bit, there hasn't been and there isn't being a reversal of course, because they are scared to death that too much of a reversal is going to incur a major crash throughout the financial system. Everything is connected. All the banks are codependent. All the markets are codependent. Money flows around the world in, at less than nanoseconds. And all of it has the propensity to collapse if the sort of level, that carpet that central banks have created is dragged from beneath the floor of all this activity.
You say in your book that this is the new unstable normal. Would you explain that and what could go wrong?
Well, so the reason this is unstable is because it's all manufacture. This activity, the collusion between central banks, is real. And the level of rates being low is real, and them having bought assets in different asset classes is real. But what's really mercurial and what's really very dangerous and unstable in this new status quo is what could happen if any of them were to shift in a manner that spooks the markets out. Now, the Fed's been very slowly raising rates while it has had its collaborators in Europe and Japan, and to a tiny, tiny extent, China, reduce rates or reduce the cost of money, so that on balance, everything really stays the same globally. But if they get it wrong, if there's just too much of a movement on one side and there isn't enough of a give on the other side of the world or with another central bank, that could create real fear in the market that this decade-long party of cheap money will in fact come to an end. They've talked about tapering, they've talked about ending, they've talked about having a strategy that reduces the reliance on what they've done for the last 10 years, but in practice they haven't really done and accomplished reducing that strategy. They just talked about it. When it becomes real action, when it becomes really meaningful, if it happens too fast, that creates a major credit crunch, that creates a major crisis of confidence, that creates a major problem in bank liquidity because it has been fed by central banks throughout these years, and that can manifest in a tremendous drop in a lot of different asset markets. Now, I think it will first happen in the bond market because the bond market itself has run amok. I mean, as much as our stock markets have increased and are at historical levels, the level of debt, both public debt and corporate debt, non-financial corporate debt that's been issued in the last 10 years is on a completely accelerated basis, even in the last two. It is epic. And to the extent that defaults start to creep in, that, again, any form of even minor rate increases incur problems with particularly emerging market countries who then have currency problems and can't repay some of the interest on that debt and so forth, and start to default, could also cause a massive ripple effect throughout the market. Again, the central banks are trying to be very careful about their activities to avoid this scenario, but the buildup is immense. And so the instability that could be incurred on the system is a byproduct of how much has been built up in terms of debt and equity levels over this decade.
DiMartino Booth, Danielle DiMartino Booth worked for Richard Fisher. She's a Fed insider, smart, very smart, and she was talking about how this is stunning to me that the Fed has no idea how this is going to shake out. And you have a similar view. I know you know her, and I think you're friends, but you two are on the same page. And you were on the Banking Insider, and she was on the Fed Insider. Insider at Goldman Sachs. Top banker. You say there's no plan B. I mean, that's kind of a extenuation of what Danielle DiMartino Booth says. She says they don't know how this is going to come down. Will you explain no plan B?
Yeah, I mean, she's right, and we you know, I've spoken with her about this numerous times. The not having a plan B is what occurs when you outstep the boundaries of your responsibilities. Now, the Federal Reserve has a lot of responsibilities that are written into the Federal Reserve Act. And one of those responsibilities is to regulate the financial system. One of it is to provide liquidity to the financial system. One of it is to ensure a particular level of employment versus inflation. There are things within the purview of the Fed and other central banks that are sort of their day job. But what's happened in the last decade is they have so gone beyond their day job in this manufacturing of multi-trillion-dollar books of assets from which they basically received from the markets, from either governments or from banks in the case of the Federal Reserve, who gave them mortgage assets, and corporates in the case of the European Central Bank, equities again in the case of the Bank of Japan. They received all these assets in return for money. Why they don't have a plan B is because they've gotten so good at it. The results, if you just look at markets and not the real economy, not the fact that wages have been relatively stagnant, not the fact that labor force participation is at 4-decade lows, not the fact that individual debt, whether you look at it from a student loan perspective, a credit card perspective, an auto loan perspective, is at record highs. If you ignore all of that, they feel they've been handling the expansion of markets pretty well on the basis of what they've done. Now, it's really hard for them to then step back and say, okay, well, how do we really unwind this? We can say some stuff. We can indicate to the media that we're going to taper because the economy is strong. We can sort of talk up what we did in that manner. But the reality that they know is things aren't that stable on the foundational economy side. The stock markets are buoyed by both their money and corporate buybacks from all of the major corporations around the world who use that cheap money, incur debt in order to buy their own stock. All of that's artificial. You have to therefore have an exit plan that incorporates the artificiality of what you've just established over the last decade. And that is what they don't have. When they speak together at G7 conferences throughout the world, when they get together at Davos, when they get together at Jackson Hole, when they are on the phone, they are not necessarily talking about, okay, we just had this 10-year plan of inflating the world. How do we even have a 10-year plan of making it normal again? They don't have that conversation because what they have created looks too good on the surface. They just hope, and the individuals running just hope. For example, Janet Yellen, who is leaving now and giving her seat ultimately over to Jerome Powell, who's coming in on February 4th to run the Fed, just wants to get out of the situation with her tenure having been okay, with no crash happening on her watch. That's not an exit strategy. That's an individual leaving strategy. And the major exit strategy is something these central bankers do not talk about and don't have.
You see things like the Puerto Rican debt that they just kissed that off, $74 billion. States like Illinois are in deep trouble. Other states have big money problems. I think Ohio, Pennsylvania, California, New York, Texas, Kentucky. There's a lot of states out there with problems. Could they push this thing over? I mean, what do you think? Where is the problem area you think that'll push this thing off the cliff? The bond market, the debt market, defaulting, inflation. What do you think will push it off the cliff?
Right. Well, just to start backwards with the idea of inflation, we haven't seen, and a lot of the people that were concerned that inflation would come into play if rates were too low for too long. The reason we haven't seen that happening is because there hasn't been any actual real growth. That's the major indication that real growth has not been a byproduct of the growth in the cheap money and quantitative easing plans of the major central banks. That's like the main thing that we see. And inflation has increased in things like the cost of education, the cost of healthcare premiums, the fact that a paycheck doesn't stretch as much in general to incorporate all of the household expenses that a normal family has. These are all things that indicate that inflation from a cost perspective and day-to-day expenses and sort of real needs of people has gone up, but the way that the inflation is measured from a GDP perspective, from an overall economic perspective that central banks do and that governments do, has not increased because there hasn't been any actual real growth in the real economy. That is an indication of the misfire of this entire plan. Of course, there has been tremendous growth in stock markets and bond markets and so forth. So when you take a look at states or localities or even governments whose debt to GDP levels are well over 100%, in Japan they're over 200%, the United States are over 100%, and so forth throughout the world, and these are levels at which they've never been. They're all at their historic highs or near their historic highs. That's why debt ultimately will be the destructor of the system. But in order for that to happen, the cheapness of money and the ability of states and localities and corporations and even individuals to continue to borrow at these cheap levels has to go away. That goes back to the reality of these central banks not wanting that to happen, and therefore not raising rates by too much, because then the cost of getting new debt to service the old debt goes down. Goes up. So that becomes a problem. However, at some point that does have to give, and at some point there will be a mistake. And there might be a tiny smidge of an interest rate hike at some central bank, probably the Fed, that then ripples throughout the system as a mistake, not because real growth has happened and that's why the interest rates have been raised. And that will incur defaults throughout the system, and that will incur personal defaults, and that will incur problems in the mortgage markets where people have sort of invested in terms of their homes and so forth since the crisis. And then it becomes a knock-on credit problem and a credit event, and then banks start not to lend as much. Not that they've lent all of the cheap money they've gotten from the Fed proportionately anyway, but they stop doing that, and then we have the makings of a broad crisis, and that's what will ultimately happen. Right now, central banks are trying to avoid that actuality, but because they've not reformed the banking system, because the entire financial system and monetary system is predicated on artificial stimulation, at some point that will give. So again, it gives first in bonds, and then it moves very quickly to stocks and mortgages and throughout all the asset classes that have been operating on bubble levels.
I mean, you're I'm listening to this, trying to keep up with your brain, which is at hyperspeed. You're very smart. You're smarter than me. But this, what is the crisis level look like? What will it look like to the man on the street?
Well, to the man on the street, woman in the street, you start to not be able to, when a crisis happens, you start to not be able to take as much cash out of your bank account. Sort of ATM levels go down from $500 for an extraction to maybe $2 or so forth. You start to have Cyprus type activity where financial systems and banks are trying to maintain the liquidity that they have to protect themselves, and that has a knock-on effect to individuals. That has a knock-on effect to raising rates for credit cards, to student loan rates creeping up, to auto loan rates creeping up, and that becomes then more expensive for people to deal with. And to the extent that wages or any types of financial packages that people have with regular employers. I'm not talking about private equity, hedge fund guys and women and so forth, but regular people, which is most of the country, then start to have problems making those ends meet. And it doesn't take long to go from missing a credit card payment to being delinquent, to defaulting on that card, to having your credit score go down and so forth. The process, when it starts to happen, unravels quickly, like we saw in the subprime crisis, which amazingly is a decade ago. I mean, I feel like it just happened yesterday, because we talk about it all the time and writing about it, so forth, and just examining what's gone on since then. But it's been 10 years ago. But why it happened was because ultimately banks created a lot of assets and leveraged debt on the back of individuals and back of individual mortgages, sold them, distributed them, lied about them, had rating agencies concur and so forth. And when the value wasn't really there in those assets, that's when sort of the market tanked, the mortgage market then tanked, the housing market then tanked, and so forth. That's how credit problems happen. They happen because banks are leveraging individual loans or corporate debt or corporate loans, and once that leverage goes wrong, everyone suffers at the bottom first.
Should people feel great about Dow 26 Dow?
Well, if they're invested in it, I mean, again, if someone has written the Dow up and is looking at their 401k plan and sort of allocated into the sector and so forth, they're looking at tremendous gains. I would personally take some of them out and sort of reallocate them into something more stable, or even into some form of cash. Again, we have very low inflation, so putting money in cash or putting money in hard assets isn't a bad strategy right now. I think it's a very prudent strategy, because at the end of the day, the Dow at 26 is a representation of growth in the central bank's plan over the last 10 years and quantitative easing and low rates that have been distributed throughout the financial system and go into bonds and go into equities because that's where you can get returns. And then they have a self-fulfilling prophecy. They move things up. Corporate buybacks. They weren't at record levels last year. They were at record levels the prior 2 years, and they will be again this year for two reasons. One is because that money is still cheap, and two, because of the corporate tax plan that has just gone in. Will be in play this year for 2018 going forward by the Trump administration, which means that companies have the choice between repatriating cash, putting it into wages and R&D and so forth, or simply buying their own stock. I believe they will be buying their own stock. In fact, I don't just believe that. This is what many of them have said. That's going to lift the market, from 26 to maybe 27 or 28,000. If you're in it, that's great. But the problem is when things come down, they come down really fast. There's a history that we can look at for centuries, really, that when markets crash, they crash far more quickly than they rise. And so just from the standpoint of individual prudency and protecting any returns you may have gotten if you are involved in the stock market, it's important to take stuff off. I'll tell you just a quick little segue. I was in Vegas this weekend talking to some investors, and as one does in Vegas, I did some blackjack, and I realized that that it is very important to have an exit plan. And we're just talking about how central banks don't, but for individuals to have an exit plan when they're up. If you're at a blackjack table and you put down $100 and you make 50, you should leave. You shouldn't, sit there and wait till you possibly go down to zero. You should take your 50. You should be thank you very much house. And you should have had a plan that said before you walked into that casino, before you sat down at that particular table, if I am up X, I get out. Will I lose the possible upside of sitting there? Yes, but I will also protect myself against a bigger downside. I'll come back another day. I will put it aside. When I can play with the house's money and accumulate up to that level, that's a different story. But in terms of my money, I have a strategic return. I get it. I leave. I preserve it. And that's what I think needs to be done right now. That's what needs to be done at levels of 26. Take some off the table. If it gets to 27 or 28, take more off the table. And preserve capital in real things, and for real bills and for real assets, in case things do implode and they go down very quickly.
In 2017, you said that we wouldn't have a market crash. I like to have a lot of people on. Some people said we were. I thought we would. I just didn't think they would hold it together. But then again, Trump got elected, and then we had this big bump. This money coming back and the tax thing. But you said it wouldn't crash, and you said gold would probably go up at the end of the year. Ding, ding. You were correct. What do you think about this year, your predictions for 2018? Are we get a market crash this year? Is gold going to continue to go up?
Yeah, I don't think we see that crash this year. And the reason I didn't think it last year and I don't think it this year is because I am looking fairly religiously at what central banks are doing, not just what they are saying and hoping to sort of provide as a message of real economic strength. And given the fact, for example, the European Central Bank is a perfect example. Last year, they said that they were going to reduce the size of their quantitative easing program. We had spoken in the beginning of the year about how the prior year they had said they were going to cut their quantitative easing, and if they did that, that would hurt the markets. But they didn't do it, so therefore it didn't hurt the markets. They had a lot of power in that. They've done the same thing at the end of last year, which will infiltrate this year, which is that they said they were going to taper. They were going to buy less predominantly corporate bonds because they're moving into corporates from governments, but they're going to do less, and therefore that was promoted in the media as some sort of a tapering. The reality is they also said they were going to extend the period through which they were going to continue to purchase. So they were reducing the amount per month, but they are expanding the period of purchasing. If you do the math on that, which I think I did, it amounted to an extra 140 billion euros worth of quantitative easing, not less, but more. So that's the kind of thing that keeps the markets up.
And so you're thinking that this whole thing's going to be engineered to continue more of the same. Don't listen to what they're telling you. They're going to cut back. They're going to reduce their balance sheet. They're going to raise rates. You're saying, no. Watch what they're doing. They're not cutting their balance sheet. They're not going to raise rates, at least not much. So your prediction is the opposite. Basically, explain it's the opposite of what they're saying. Is that what you're telling us?
Yeah, I mean, just look at the numbers. I think ultimately you have to look at the facts and not the words. So not the fake central bank stuff, but the actual real central bank stuff, because that actually is what is fueling and has fueled these markets. I mean, you can look at multiple charts on this. I've had them through stuff. There are a lot of good research sites out there like Erdeni Research and things like that who show the very, very, very tight correlation between the level of markets and the level of debt and the size of the assets of the central banks, the major central banks, and what they're holding. So that's what you need to look at. Little adjustments, yeah, absolutely. I look at them, and that's something to be aware of. And if they change dramatically, then I'll view that information as well. But for the time being, what they say and what they do are really two different things. And what they do is what we need to be aware of.
Are big money, you've been all over the world with this book, two things. Are big money players increasingly getting into gold for this reason?
Big money players are, and also central banks outside the U.S. are. So when you look at the increase in India and China and Russia and so forth in the gold components of their reserves, of their balance sheets, and the continuation of them doing it. They're doing it for two things, and one of them is the reason that the dollar decreased dramatically over this year relative to major currencies, is they're doing it as a diversification, which is exactly what I was talking about for individuals to consider in terms of diversifying into hard assets. They're doing it as a political and monetary diversification as well, not kind of simply as an investment diversification. And what they're saying, for example, People's Bank of China, I talk about this a lot in the book, they pushed very hard in the wake of the financial crisis because they didn't think that what the Fed was doing made any sense, because they were very vocal for really the first time ever in the world about their criticism for what the Fed was doing in terms of quantitative easing and potentially creating bubbles from it, from which there would be no escape. I mean, there's lots of quotes I have on that in the book, most of which were public, and no one was paying attention to them. But what they decided to do was get their currency into the IMF's basket, into the special drawing rights basket, which is just a collective representation of the major currencies in the world. And the Ren, the Chinese currency, was not in that until the end of last year. And now it is. And it is because the People's Bank of China and the government of China decided to push for that inclusion and to make a real play for having their currency be part of the reserve currencies in the world. And they did a lot of side deals with Russia and so forth to encourage trade within the local currencies, as opposed to bringing them trade back to dollars and so forth, to just avoid the reliance on the dollar and more importantly on dollar policy, on Fed policy, on what the U.S. government would do and so forth. They've done the same thing with gold. I believe that ultimately there will be a gold component of the IMF's special drawing rights basket. It doesn't necessarily mean we go back to a global gold standard, but it does mean that there's something, sort of hard outside of sort of fiat currencies that's there as a sort of reliable alternative to simply those kinds of currencies and central bank movements. And it's not necessarily going to be the whole basket, but I believe that is something that these external central banks do want, because it gives them leverage against the dollar politically, monetarily, and also from a just pure economic trade perspective. It allows them to make their own policies to a more independent extent than simply relying on the dollar and its policies as having been the major reserve currency. So that does increase the value of gold. That does increase their desire to own gold, which we've been seeing. And it also decreases the value of the dollar relative to not just the major currencies, but to any of the central bank currencies that are in the process of buying more gold.
You said the dollar would get weaker last year. Ding, ding, ding. You were correct. What do you think about the dollar? Is it getting weaker or stronger?
Yeah, I mean, I think it's going to get weaker as well. What's very interesting is the diversion in the level of the price of the dollar. And the dollar has actually gotten stronger relative to certain emerging market currencies. It's gotten weaker relative to the major currencies. That's what I said would happen. That's going to continue to happen. But it's also have this interesting diversion from our stock market levels. So you do see the Dow up over 26, and you see that the dollar has not increased, which would be the expectation in sort of a normal non-central bank calibrated world. You would expect a strong currency to attract capital into stock markets, and the two would rise together. We've had the exact opposite happen, and if we've already had it happen with the Fed being the only major central bank hiking rates by a smidge, and with our talk about a strong economy not necessarily having a strong economy, and the level of capital going into our stock markets, if the dollar didn't appreciate because of all of that, relative to other major currencies, there's nothing to indicate it's going to appreciate this year relative to those currencies. And in fact, the more they do trade together, the more they diversify away from the dollar, the more the dollar will weaken relative to the major currencies in the world. Again, it could strengthen and continue to strengthen relative to certain emerging market currencies, but not to the major currencies.
You would be a buyer of gold.
Yeah, I would also be a buyer of silver, because as that track goes, because silver is also sort of a used hard asset, and it's at really cheap levels right now as well. So I would be a buyer as a percentage of my portfolio, and in fact I have done exactly what I'm indicating I think is a good idea to do, which is to take money from the stock market and put it into hard assets to preserve both the upside and the profit that people might already be realizing.
You sound like Gregory Mannarino. That's what he does. One quote from the book, one thing that just jumped out. You went all over the world. You traveled the world. You talked to tons of people in just about every continent on the planet. What's the one thing that somebody told you? You went, I can't believe they told me that. I can't believe they said that. I can't believe they admitted that. Give me one thing that you have in this book that's coming out May 1st. What would you say that would be?
I think the thing that keyed me into just this entire premise that I'm talking about, of the collusion, of the actual impact of all of the central bank policy on all of the markets, it's probably in the beginning. One of the countries I went to first was Brazil, and this was before the old Dilma Rousseff government fell to the new Michel Temer government that's in place right now. And I was talking to some of the central bankers who ran the research department of the central bank in Brazil about this, and they did this really amazing analysis of global central banks and like the timing of their movements on the respective markets. And it was actually one of them that said, you know what, there is no unwind policy here. I mean, if you literally look at the research, look at the numbers, look at the analysis, there is no unwind. And it would be very hard to coordinate an unwind, even if there were, the way you coordinated what just took place over the past decade. That's not the exact quote, but it's in the book. But that idea was very compelling, and I sort of followed that idea as I went, to China, to Japan, throughout Europe, and so forth, examining this.
So the unwind policy. So the unwind policy is basically going to be some sort of horrible crash at some point.
Yeah, and a reaction to it, which could be more of the same, or it could be just panic.
Tell us about what you're doing. You're going to give me a link. There's going to be this doesn't come out until May 1st, but you can pre-order. You can pre-buy it. Tell us about what you're doing for the people watching this interview.
Yeah. So and also, Greg, we've been talking for years, and so I wanted to be and your viewers have been wonderful in terms of support and so forth, as have you been. So with a couple places like that, with you in particular, I've spoken with my publisher about offering really, they're not, I don't actually sell the books myself, but as publishing works, a discount on pre-order. So between now and May 1st, if people go to your website and the link that we provided you, I think it's like a 40% discount. So it gets very close to sort of wholesale values on the books. books. That goes up to real prices on May 1st when the book comes out. But that's just something that we talked about doing with you and for your viewers. So hopefully people can take advantage of that. And also, I have on my website links to where I'll be doing events and so forth throughout the country and the world when the book does comes out. So hopefully people will, in their respective areas, come out and participate.
Listen, I think I'm your first interview on this. Is that right?
Yes.
That's fabulous. Listen, folks,
you're the first person also holding up. That's a galley copy of the book. That's not the hardback yet. So yes, you're out the gate. I really appreciate that.
Well, I really appreciate it too. And so the links will be, in the after the interview section for you folks on YouTube. You could just go back to USA Watchdog, click on the back link. We'll put your website up. I think it's nomiprins.com. Is that right?
Yeah, that's right.
And your book's on there too, but all the special link will be also in the after the interview section, so you guys can pre-order the book and get it at a real discount. Nomi Prins, thank you so much, a 2-time best-selling author. Hopefully you're going for the hat trick right here, a 3-time best-selling author. Nomi Prins, thank you for joining us today on USAWatchdog.com.
Thank you.